Welcome to the MarketEdge Tech Talk with Will Paule and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
Hello and welcome to the Tech Talk for Tuesday, August 9th, 2022. I'm your host, Will Paule, and I'm here with my co-host, David Blake. How are you doing today, David?
I'm doing good, Will. Thank you.
All right, let's start off with a look at what the market's been doing this past week with a look at the market letter.
All right, well, last week we had a little bid of a mixed reaction in the market after 2 weeks of really solid gains by the major averages. We actually had the different indexes finish mixed. Now, what we had going on was we had investors were kind of looking at better than expected earnings, but then we had to kind of look to see whether or not the Fed's aggressive tightening policy was going to slow down earnings going into the third quarter. Now we're already starting to look ahead or whether we can keep on keep this rally going a little bit. The week started off a little bit rough. We had House Speaker Pelosi going over to Taiwan that China kind of ruffled their feathers a little bit. We saw stocks fall across the board on Monday and Tuesday. And in fact, on Tuesday, the Dow was down about 402 points, down 1.25%. And a lot of the Chinese stocks were lower. We weren't sure what was going to go on over there, but things got a little hectic. But we were able to bounce off of that after the tempers flared a little bit, and we had some strong earnings come in from the likes of PayPal, Starbucks, LCI Industries, and others. And then we also had a little bit of an improvement in the July ISM services index, which showed new orders still coming in strong despite the rate hikes that we've had. We also saw a little bit of easing in the supply bottlenecks, and that kind of had started another little bit of a rally. Again, what the market's hoping for is that we can raise these rates, bring inflation rates down, and not cause a recession to hit here. And we start seeing new orders and stuff start to pick up. That's a good sign that perhaps we can sidestep a recession. Well, we had the Dow reverse the Monday and Tuesday losses, and we had the NASDAQ jump 2.59% and actually traded above the June highs on that Wednesday. We had traders coming in there to pick up the big cap technology names. That, of course, leads to the outperformance in the NASDAQ. And this is going on in the background. We have some of the Fed presidents, James Bullard in particular, came out with some hawkish comments saying, we got to keep this rate hike cycle going. But while they're saying that, we're also starting to see longer-term yields start to come down. Now, the yield curve has been widening, which is still hinting that we're probably still going to have a recession towards the end of the year. But with as long as the data comes in fairly strong, the investors are hoping that we're not going to fall in a recession. That maybe we can, there'll be enough money out there that we can keep the earnings going. But we had a little bit of a pop in housing stocks, and we saw mortgage rates actually fall below 5%. I had said that they fell below 6% in Friday's letter. That was my mistake. They actually fell down to 4.95 or something like that. But then we were mixed again on Thursday ahead of the jobs report. It came out on Friday, and Friday's job was a little bit of was kind of troubling. We were kind of hoping, we would like to see, initial jobless claims start to go up, which we have. We're seeing it go up maybe 4,000 and 5,000 a week, but all of a sudden we had payrolls jump by 528,000. That was about double of what the market's looking for. Now, one of the problems with the Federal Reserve, one of their things they see the economy slowing a little bit, but the impressive jobs numbers are going to keep the Federal Reserve, raising rates. I'm sorry. Okay. Anyway, so we saw the unemployment rate fall into 3.5%. That kind of gave the Fed free rein to stay aggressive on rates. And as the week was ending, we had some analysts saying that perhaps we're going to see if not 3/4, maybe even a 1% hike in September. And just about a week ago, we were looking at maybe probably a 0.5% would be it. I think by the time we folded up on Friday, the chance of a 0.75 point rate hike was up at 68.5% on Friday. That was up from just 28% probability of that a week ago. That's from the CME Group Fed Watch, which pretty much follows the money on what people are betting on what the Fed's going to do. So that gave us a little bit of a rough start, a rough finish to the week. As far as the week goes, we kind of churned sideways actually through it all. Technology, consumer discretionary, and communication services were actually higher with the rates going up. And then the losses were kind of offset by energy, materials, and healthcare. And that left, like I said, the major averages kind of mixed for the week. And we've been mixed now for about 7 or 8 days, kind of going in a sideways pattern as we get ready for some more economic data this week. Technical condition of the market was little changed. It still remains bullish. We look at this kind of when we're going sideways like this, it's got a little bit of a consolidation phase. As I said, we've had some big gains off of the June lows. In fact, I'll talk a little bit about that before, but we've had double-digit gains in just about everything as of noon this afternoon when I was looking at stuff. I think the Dow Jones is up about 9.8% off the June lows, but on the far side, we have the NASDAQ up about 17% off the June lows. So we've had a pretty powerful rally. As far as the technical indicators go, a little bit of deterioration last week as we were kind of going sideways. MACD, which just shows a short-term trend, it remains positive, and momentum measured by the 14-day RSI, it also is bullish. Now, we did see the different indexes cross the respective 100-day moving average last week, and they did close above it. They're still kind of struggling around that area this week, but that's a positive going forward as long as we can stay above that key moving average support level. We also saw the NASDAQ and the Dow Jones Transportation Indexes break above their June highs. We've talked about that as a major resistance area going forward, which we'd like to see the major averages break above that if they can. I mentioned that in last night's daily comment that we could possibly start to see some short covering if we see the major averages cross through that, and we could give us another leg higher. Another positive for the market, we just see some of the secondary indexes that include the Russell 2000 and Philadelphia Semiconductor Index outperform the broader market. As technicians, we'd like to see some of those secondary indexes lead the market higher and lower. And at the close, we saw the NASDAQ hit its highest level since the 1st of May. So I think it was at about a 4-month high. That's strong. It was able to break through that June high resistance, and actually it broke through that resistance on good volume. The Dow Jones, the NYSE volume last week was actually a little bit below average, but the NASDAQ was actually a little bit above average volume, which is good. And a lot of that was because people were buying some of these beat up big cap tech stocks. They want to be getting in that. Underlying breadth remains positive. We had the AD lines also move higher for a third week. That shows decent participation in the current rally. And we also saw the new 52-week lows contract even more. And on Thursday and Friday, then again last night, we actually had more new highs than the new lows. And for the NASDAQ, that's the first time since early April. Today we don't have that. We're having a little bit of a down day today. We'll get into that later on. Sentiment also is becoming a little bit neutral. We were very bearish for several weeks. We had the American Association of Individual Investors, the AAII survey, had about 30.6% of retail investors were bullish. That's up from just about 19% just a month ago. And just a little bit below the bears. There's still about 38% of the retail investors are bearish. And then as far as the percentage of bullish investment advisors and percentage of bearish investment advisors, we actually had the bullish investors were above the bearish investors for the first time for a second week in a row, and that was after about 11 weeks of being of more bears than bulls. So sentiment is coming back towards a more neutral stance. Momentum, like I said, remains strong. We had a little bit of a surprise there Friday with the jobs report. As much as we'd like to see everybody working, strong jobs report means that the Fed is going to be more aggressive raising rates at some point. As they do that, it's going to just be a little bit tougher not to throw the economy into a recession. But for right now, we're kind of watching things. We're up to a kind of an fluctuation point in the market right now, in the major averages, where they are as far as support goes and resistance goes. And, we're going to have to really kind of watch things right here.
The major averages have rallied back to June highs, which we've talked about over the last few tech talks. Can the market continue higher, or do you think we could see the rally run out of steam here?
Well, I just said we've had a pretty impressive rally off the June lows. I mean, when you listen to all these analysts come on TV, you hear it might be a rally in a bull market, and that we're going to retest the lows. That's imminent, and quite frankly, with this much, you do have strong rallies in a bear market, and that's a known. But to be truthful, we really don't know. There are indicators out there that we look at that are going to influence our decision whether we think the market can move higher here, or if the current rally looks weak, whether it's going to stall out at resistance, that type of thing. And if, as a subscriber to MarketEdge, you can follow some of these indicators that I look at and others look at. Well, how about going to the market recap page?
All right.
It's off of the home page. Everyone should look at this, a couple of times a week. Okay, one of the things that we look at is underlying breadth. What we want to see is whether is breadth supportive of higher prices? Is it going to show? Is it going to show in the rally or sell-off is due to a handful of stocks, or is it just overweighted stocks or sectors? And if you go to the market recap here, you're going to be able to see exactly what we look at. Now, the first things we're down here in the middle of the page, you're going to see the NYSE advanced decline and NASDAQ advanced declines. And here we can see that the AD lines for both the NYSE and NASDAQ, you can easily see here, that, especially on the NYSE, that the majority of stocks right now are under accumulation, and that is supportive of higher prices. Yeah, a lot of times, the NASDAQ not quite as much, but it's showing a nice trend line up. And you can also look at these AD lines as trend lines of what's going on underneath the market. Now, often, the thing is, you'll see negative or positive divergences in these lines, and what that is, that shows up when the charts are warning of a top or a bottom. In other words, you might see the stock market trading lower, but if you come to the market recap and look at the advanced decline lines, you'll start to see them going sideways to up. Like if you look at this little section here on the NASDAQ over at where it's bottom, it kind of bounced off the bottom sideways there. Okay, that was when the market was still kind of going down a little bit. That was showing some positive divergence in the fact that even though the market was going lower, whereas the AD line was going sideways, which it kind of gives you that positive divergence, which means, hey, even though this market is going lower, they're buying stocks here. So they are under accumulation, and that positive divergence was giving you a little bit of a warning that a short-term bottom could be in, and we should see maybe the market was going to turn around and start heading higher. Just below that, you can see contraction in the number of new 52-week lows on both indexes, and this is another positive sign. It means that we're not seeing investors dumping everything, and when you see these spikes in the green line on the NYSE and NASDAQ, that's pretty much, even though stocks are down near 52-week lows, investors and traders are still selling them. They want to, they think they're probably going to get lower. So when it's a positive sign, it means that you're not seeing, you're seeing they're buying stocks, even though we're still, some of these stocks are down 40-50%. You're not seeing them just dumping them, saying, I got to get out of here. So, even though some of these stocks, will look cheap to traders, they're just no longer, they don't just want to sell them just because they want to get out of the market. They think, okay, well, they're down, they're beaten up. I'm not going to sell it though. I think it's we probably have a better chance of going up. Now, finally, right below that, you can see the CBO VIX underneath these charts. Okay, now you can see a pretty steady line on the VIX coming down from, let's see here, where was it? I'm sorry, I'm going to pull my chart up here so I can see a little bit better. Okay, pretty much a steady line there from several months ago. And what that tells you, the VIX, they call that the fear index. It's kind of a little bit outdated, but what this kind of tells you is it measures the puts and calls by traders. And when you have, what this is showing you, when you get down here under, the low 20s and below 20, that pretty much means that whatever's in the market that's going to throw it for a loop is basically has been discounted. Now we've seen a pretty nice little steady move down, which means that the traders are they're a little more comfortable with what's going on. When a lot of times you'll hear the VIX needs to spike up into the 40s to signal that we're going to see a capitulation bottom. And what I mean by that, that's when investors are going to throw the baby out with the baby water or with the bath water, and they just want out. In other words, they're buying puts. They just want to get out of here. They just think the market's going down, get me out. But that isn't always the case. I mean, a lot of the times it is, but we don't have to go and have a capitulation bottom to mark the end of a bear market. If it was that easy, we'd all be making money. We just sit here and wait for the market or the VIX to get up to 50, and then everybody pile back in, and we'd all make a lot of money. But that's something to be aware of, because sometimes they call it also a selling climax, that type of thing. But the fact that we're kind of steadily nudging down and over a period of time means that the traders and investors are becoming more comfortable with the fact that, okay, despite these rate hikes, maybe we're going to avoid a recession, that type of thing, and they're not showing a lot of fear in the fact that if we raise rates one more time, the bottom's going to fall out of it, and then we're going to recession. The VIX is telling you that we're going to give the Fed some room, and of course, with all the money that we got up over the last 2 years from people in the government, stuff like that, maybe we can get some higher rates to still avoid that. So that's another positive sign in here that it looks like the traders are becoming a little bit more comfortable with with how the market's reacting to the Fed's rate hikes. Finally, it's just underlying breadth. When we look at these charts, what we're trying to find out is are they supportive of higher prices, from here? And right now, I mean, they're at this stage they're pretty. I would say in general they're supportive of some higher prices. Now, these things can change quickly. Like all of a sudden, if you come out here and the Fed raises rates, 1% and says we're going to do another 1% in November, that can change things. Or if you come in here and all of a sudden you see the CPI or PPI this week, if they're looking for 8 and it comes in at 10, you're gonna have that way you can see the VIX pop up and stuff like that. But in general, underlying breadth is not showing any negative divergence that we're ready to roll over yet. Okay, so next thing I'm going to talk a little bit about is, and we can go to the chart page here on this, Will, is something else besides underlying breadth. We want to look at what the secondary indexes are doing in the market. Okay, now I talk about these in the weekly market letter. And as I mentioned earlier, technicians like to see these indexes, which we'll call like the small caps, the transportation index, the Philly semiconductors, sometimes even the biotech indexes. And we want to see if they're going to lead the market higher or lower. Okay, and that's one way that we can figure the market's momentum. In fact, it's the market letter, the momentum index is based a lot on whether the broader market is outperforming the Dow or whether the Dow is outperforming the rest other indexes. Now, last week and the last 2 weeks, with the momentum index has been a +8, which is very strong. And the reason that is that high is that right now off the June lows, the Dow Jones has rallied about 9.8%. That's as of this afternoon sometimes, so it's going to be a little bit different. That's off the June 17th low. Well, the S&P 500 is up about 12.5%. The NASDAQ is up 17%. You have the small cap Russell 2000, it's up 16%. And the Philly Semiconductor, it bottomed out the 1st of July. It bottomed out about 2 weeks later, but it's up 19% off of that. And even the transports are outperforming the Dow Jones. They're up about 13.5. So that is another. All these other indexes have outperformed the Dow. That's another positive going forward at this stage. So that gives us another little bit more of a boost. That okay, well, I don't think we're going to roll over and head south and retest the old highs again. Now, there's an old Wall Street adage you'll hear once in a while. It says, "Be wary when the generals march alone," and what that means is that happens when the secondary indexes are lagging the big board. And now that's a red flag. That means you've got your IBM, you've got your Merck, you've got your your big guns, your Chevron, Exxon. They're all making new highs, but everything else is saying, we're not cutting it quite yet. And you'll see that happen when the Dow Jones is up like say 18% and everything else is up like 13 or 14. That's a negative divergence, and you start seeing the momentum index fall down to like a -4, -5. Okay, we also have talked about sentiment over the last few weeks, and that's another thing that you just want to weigh in with. Back during June, sentiment had reached overly bearish. I mean, it was as bearish as it was, say, back in March and April of 2020, right when the pandemic came and everyone thought, we're going to zero. So recently, over the last couple of weeks, despite what you see on TV, everyone on TV says, okay, everybody's still overly bearish. I'm seeing signs that investors are putting money to work in here. Again, they're starting to buy the dips. When we see the market has had several days where we open up and we're down a certain amount, and we end up the day flat a little bit. We now see the bulls and bears are at about 60-40. So that indicates that we're okay as far as sentiment goes. And when we start seeing whether everybody's bullish, everybody's talking about we're going to new highs, that's when that would be a bull. That's a little bit overly bullish, and then we start seeing things a little frothy. And we're not there yet either. So right now, that's most of the stuff that we're looking still says that we can work our way a little bit higher. I want to go real quickly. You've got the charts up here, and this will be the last thing before we wrap this thing up. I've talked a lot about we had talked about the June highs, and as far as targets for the S&P 500, it was 4150 to 4200. Yesterday we hit 4185, so we basically hit our target for the S&P 500. The Dow, I was looking for about 33,250. I think we got to 33,150 or something like that, either yesterday or today. The NASDAQ has already hit our goal. That was 12,550, something like that. So we've reached the goals that I had from off the bottom using some of the Fibonacci retracement tools that we have on MarketEdge. But I did want to show you some of these things here. Now, this is the Dow Jones. As you can see, yesterday and again today, we didn't quite hit it. But yesterday we came just about to that June high. They were very, very close. Within a matter of points. Also, if you have this trend line, you could draw down from the January highs and draw it down through the April high, April 1st high, and then maybe touch a little bit of that May high. We actually saw that we bumped into that downward trend line yesterday early before we bounced back off of that. And we also then we pulled back into the we're still above the 100-day moving average, so that's an area that we want to keep our eye on. All the major averages crossed that here in the last week. That now becomes support. But then you also look at the Fibonacci retracement level, and we're right now we are above the 38.2% retracement level, which is usually when you get to that, you're going to get to the 50, and we actually hit the 50, almost hit the 50 yesterday at the open, not quite. So that area happens to be right in line with the June high. So if that would even be more impressive if we see the Dow Jones cross above the June high, also cross above the 50% retracement level. Normally, when you see a stock or an index cross that 50% retracement level, you'll see it head on to the next point of resistance, which would be up here around. If you look at the March first high where we went up and pulled back, and then we bumped up against that 61.8% level back there in May, the end of April and May too. That would be our next point of our next target if we can break through this 50% level. I don't have that on here. It looks like it would be about 34,000, 3450. Somewhere in there would be our next target for the Dow Jones if we break through this. If we can break through these June highs. So keep that number in mind. Can you pull up the S&P 500?
Yep, bring it right over.
Okay. Now the S&P 500, like I said yesterday, 4,200 was. Oops.
It just stopped sharing the screen. Hold on.
Got it.
All right, there you go.
Okay, now you can see on yesterday, the S&P 500 also came up there to the June highs, and that's a number that we'd like to, is above the 38.2% retracement levels, and we're coming up to the 50% retracement level, which would be somewhere around 4220. That would be the next level of resistance. Beyond that, you're going to see that trend line, which is somewhere also up around 4220. So it's getting up where it's a make or break time period on that. Again, as we watch the underlying breadth, if you look at the volume, the MACD is moving up. You see the 14-day RSI, it's moving up as we're getting into that resistance areas. You want to see that. You don't want to see the S&P 500 getting up here, break through the June highs, and then you look down the 14-day RSI, and it's actually going down, which means you broke it, but you broke it with less momentum. That would be a sign of negative divergence, which means you may start to see the market roll over again. Let's go to the NASDAQ. This is a little bit better, but there are some conflicting signs in here. The NASDAQ did break above the June high with good momentum, and you can see in the 14-day RSI there that it keeps nudging higher. That's a good sign. That is supportive of higher prices. We are sitting here now because of the distance that the NASDAQ has fallen further. It's up here now, bumping up against its 38.2% retracement, and its 50% retracement level is going to be up here around 13.4 something, somewhere around that area, and that'll be the next sign that we a target if we don't stall out in this area. That would be where we would expect to see the NASDAQ move up into. Again, the AD lines are supportive that we're going to we can get to that 50% retracement level. And that would be, again, another big plus for the market going forward. Can you go to the Russell 2000? Look at the small caps here. Okay, the small cap is just breaking out above its June high, and it on yesterday or Friday, one of the two. It actually yesterday, I guess it actually came up, bumped into the 38.2% retracement level. And if you go back across there, you can see that that 38.2% retracement level, that is also kind of where we kind of tried to hold in February and also in March a couple of times. We bumped up against it in May, didn't quite make it in June. So we can see that the small caps are right here again at that fluctuation point. We want to see if it can, it's getting ready. It's crossed above the 100-day moving average. We want to see it get above this 38.2% retracement level and head on up to the 50%. That would be again bullish. The AD lines on the Russell 2000 are also supportive of higher prices. The last thing we can look at, if you want to, would be the SOX. That's the Semiconductor Index, and it got up almost to the June highs, and then it kind of rolled over here the last couple of days. Now this is a little bit troubling because it's affecting some of the sector leader groups. Yesterday we had NVIDIA warned of revenue shortfalls. Today you had Micron come in and warn of some revenue shortfalls also, and that is you've had a pretty good pullback in the the semiconductor index, and that's one that we'd like to see, lead the market higher and lower. In fact, we had that index break below its 100-day moving average, which is kind of a negative. We want to see if it can come down here and maybe hold the 50-day, and that would provide some support for that. But that weakness in the semiconductors is going to weigh on the technology sector as a whole. During this rally, technology, consumer discretionary, which are and communication services to boot, those are some of your big growth sectors where you want to see, when the market, the growth stocks are starting to outperform. Those are the sectors you're going to lead. Now, as far as if you can put up XLK, you'll see here we had a nice pull up. We got up here. We're actually just short. It's up here. We got above the June highs. So that's what we wanted to see. We're up butting up against that trend line there, as you're showing. And we're also we're above the 38.2% retracement, but we're below the 50% retracement level. So we want to watch that. It's kind of bumping into some resistance here because of the semi-index. The other one, XLY, pretty much is the same way. It has moved above the June high, which is showing positive divergence for growth stocks. But then again, today we're starting to see another pullback in that, which is okay. I mean, because the market is a little bit overbought, but we do want to see these leading groups continue to keep their leadership. We're not in a position here where we want to start seeing a rotation into value stocks again if we're going to move much higher. But I looked at some of the other sectors. We don't need to go through them, but a lot of them. But those two, like I say, have gone above the June highs. That's a big plus going forward. However, financials, consumer staples, industrials, healthcare, they haven't been able to get above that resistance level. We want to kind of watch that. So it's not something to be worried about. I just want to say that right now, as far as can we go higher, yeah, but we are somewhat overbought for this recent run, and I think that going sideways in here is basically the market consolidating those gains and wants to see. I think what we're going to see this week with the CPI, PPI, and we'll start seeing more analysts talk about the need. We'll also hear some of the Fed presidents talking about what's going to happen. Are they going to raise a half point, 3/4, a whole point, whatever? So if we see the indexes pull back here over the next couple of days and they hold the 100-day moving average, I would consider that a win for the bulls, and that would allow maybe a good place to if we see it bounce off of that 100-day and start to move up again. I think maybe you could, especially for traders, maybe to buy some positions that you could see benefiting from the rally. Also, some of the stocks that are benefiting from the Inflation Reduction Act. We talked a little bit in the letters about the EV stocks and some of the solar stocks, that type of thing. Those would be good. But the wild card to all this, whether we're going to keep on going a little bit further, is going to be what we see with some of this key inflation data coming out. I think when we watch the underlying breadth like what we just did, we're not seeing any negative divergence in that. If we start seeing the market starting to go up a little bit higher or go sideways, and we start seeing those AD lines start to roll over, showing negative divergence, that'll be a red flag, and we'll talk about that on Tech Talks. If we start seeing an expansion in 52-week lows, that would be another little bit of a problem. Another thing we didn't mention is we have the CTI, our cyclical trend index. Looks like we're going to show some weakness here, possibly at the end of August, maybe going into September. So to wrap it up, I guess with all that in mind, I would remain cautious here. I think we can work our way a little bit higher. I wouldn't be say jump in here. I do think that some of the boring stocks that you own, maybe like some of the consumer staples, food items, personal items, that type of thing, they have held up the best this year. I think that they probably will help hold the market up a little bit here. If rates they start talking again too aggressive, we know that can hurt some of the big cap tech stocks. And last thing I wanted to say was that I think, historically, when the market comes off of peak inflation, you actually do see tech stocks outperform. But I do want to remind you that generally when you see peak inflation in the past, we've come at about 12 times earnings. Right now we're at about 20 times earnings. So you may not see that big tech bounce off of here. So anyway, at this stage, I think we can work our way a little higher. Stay cautious. Look at these fluctuation points that we've talked about, and keep your eye on that market recap in the market letter, as I think that that'll give you little hints on negative divergence if we think the thing's going to stall out here.
All right. Well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, email it to support@marketedge.com or ask one of our live chat representatives to pass your question along to us for the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.